some of the concerns we have about inflation further out into the cycle, but we also wouldn't be absolutely negative on the outlook for bonds either. So from here, positive on equities, but a neutral view on bonds. We think if you investors are interested in owning credit, both investment grade and speculative grade, even after the rally in both those markets, we still think spreads can continue to narrow. We therefore still believe that there are still positive returns to be had by holding credit and fixed income. Commodities, you won't be surprised to hear when you heard about our economic view that a commodity cycle remains, I think, positive, an ongoing generalized appreciation of commodity prices, including oil, we think will continue to transpire over the course of the next 6 to 12 months. So commodity-related investing, whether it be in equities linked to commodities or indeed direct investment commodities themselves, we believe over the next 6 to 12 months will yield positive returns. And finally, in just thinking a little bit about how you might want to think about helping investors position themselves today for potentially that growing inflation risk further out in the cycle, we would start to argue that increasing your investors' share of what we call real assets relative to financial assets looks to us to be a sensible investment decision to be taking today. Increasing exposure, for example, to real estate investment trusts looks sensible. As I said, increasing exposure to commodities looks to be a sensible decision to us relative to what we call more general financial assets. Now let's talk, if I may, to finish off with some of our thoughts about once we've got beyond the next 12 months and once we've got beyond 2010, what kind of global world are we going to be in? And thinking in particular about what I'd call the echo effect of the financial crisis. I think that echo will be heard and felt for perhaps 5 years into the future from today. That echo will come in the form of potentially much, much higher inflation than we've seen historically in the recent past because of that huge monetary stimulus that we've seen and that huge growth in the monetary base in the US, in the UK, and the impact that's likely to have potentially on inflation as we move further out into the cycle. That echo will also be felt in governments holding much, much bigger deficits, particularly again in Western Hemisphere markets, and the impact of ultimately fiscal tightening, which will need to take place in order for governments to rebuild and repair their balance sheets, will lead to, we believe, a period of weaker economic growth further out. We also believe that as individuals, and not just governments, look to repair their balance sheets, we'll also see, relative to history, a relatively weak, a relatively benign, anemic consumption growth environment in Western markets. As individuals, particularly in the US, a lot of whom, as I said, have lost their jobs, try and rebuild their assets, try and repair their balance sheets through increasing saving. That protection, if you like, that governments will clearly want to see labour markets in their own economies improve. And we believe one of the risks that governments, in order to achieve that, will try and implement a more protectionist-like type of strategies to try and protect their domestic economies from international competition. So one of the risks that has been created by the financial crisis that has led to a labour market crisis is the risk of protectionism appearing, which will be clearly bad for economic activity because it's bad for trade. Another issue I think is not getting much attention at the moment, but I think is important, is that for as long as governments continue to invest and spend in order to bring about economic recovery, for every dollar that a government spends is a dollar that the private sector won't spend, as the private sector gets crowded out. By that we mean investment in infrastructure that would typically be done in the private sector is now being done in the public sector. So private sector economic activity doesn't recover as quickly. One thing we know about private sector investment versus public sector investment is it tends to be more productive. Private sector investors are driven by a profits motive more so than governments are. And that profit motive tends to lead to secondary jobs creation, innovation, and greater profitability. And we believe for as long as governments become a bigger share of economic activity, productivity levels again more likely in Western markets than in this part of the world, are likely to fall and likely to therefore lead to, relative to history, weaker economic growth. Investors have long memories. The 1930s depression in the US arguably was influencing investors' decisions well into the 1960s and 1970s. When you look at the proportion at which investors were holding bonds versus equities throughout the 1960s and the 1970s in the US, with the average investor holding a significantly higher proportion of bonds versus equities, you could argue that was largely due to the impact on confidence and the impact on investors' mentality that the depression of the 1930s had. Now, arguably, the last 12 to 18 months or so is going to leave a scar on investors that could clearly influence how they think about equities versus bonds for the next 10 years. And so we believe generalized higher risk aversion, as we would call it, could clearly impact how riskier asset classes perform over the medium term as well. And finally, I think we are unfortunately in somewhat of a more volatile world than we were in the 1990s and early part of this decade. Economic fragility is higher than it was historically, and that just means we're going to have to, unfortunately, as investors, live with more frequent periods of market volatility than we've been used to in the course of the last 10 years. But I want to finish on a positive note, not a negative note. As with every economic recession, as with every downturn in markets, there are always opportunities. There are always opportunities for investors to grow their investments, to grow capital. And this time round, it's no exception. A combination of financial and monetary sector reforms that we believe will take place over the course of the next 3 to 4 years will ultimately bring about, I think, a safer world to invest. Monetary policy will change. The way that central banks set monetary policy, the way that central banks factor in asset prices into that setting of policy, we think will bring about a more effective policy setting environment for central banks. Financial sector reform, under the broad heading of supervision and better supervision for banking and the banking sector, will bring about a safer, more stable banking sector. More effective monetary policy, a safer banking system is good for investors. Clearly, the financial crisis, we believe, has rather than permanently changed the landscape in Asia, has temporarily halted the ongoing secular trend towards higher growth, higher unemployment and higher productivity in the Asian region. And we believe that process will continue and continue strongly during the course of the rest of this decade and into the next decade. Arguably, rather than being less likely now, perhaps more likely now than before the financial crisis, is an argument in favour of decoupling. Particularly if you think decoupling means two different parts of the world growing at two very different growth rates. You can start to make a stronger case that that's what's going to happen over the course of the next 5 years in terms of the growth differential between the Eastern Hemisphere and the Western Hemisphere. And that clearly has implications for investment, taking advantage of opportunities between those two regions to add value for your clients. The commodity supercycle clearly is linked to that with regard to secular improvements in growth and activity and the implications that has for the use of natural resources. And finally, infrastructure investing. And this is now no longer a theme that we think has been important for growth in Asia. I think it's increasingly going to be a theme that's important for developed markets as well. Roads, bridges, rail networks in the US, in the UK, and Europe are getting old and getting older by the day and need to be replaced. This arguably, the financial crisis that is, has arguably been a catalyst for at last governments to recognise the need to reinvest in infrastructure, and that this process will now begin and will now to engender stronger economic growth, greater productivity in Western economies. Now clearly that means for us as investors that there are huge opportunities out there to invest in these themes, whether it be commodity related, whether it be Asia related, whether it be improvements in the financial system, whether it be the theme of global infrastructure investing. These are clearly opportunities that can be reflected through how you choose to invest in equities, how you choose to invest in bonds, and how you choose to invest in alternative asset classes that can lead to really powerful investment gains in the future. And so I'll finish by saying we've had a tough environment. It's getting better. We believe it will continue to get better. And let's not forget there are significant investment opportunities out there. Terima kasih.